Good morning, everybody. This is Economics for Managers. My name is Jafar Alavi. If you see this video, that means I could not make it back. I'm outside the country, and hopefully I will see you in the next session. So what I'm going to do is go over the syllabus first, and then cover chapters 1, 2, and 3, and you can watch this at your convenience. First, the syllabus. Let's look at the syllabus together. On the first page of the syllabus, as you can see, we have the general description of the course and what is expected to learn out of this class. On the second page, we have the textbook, which is Economics for Managers, which is specifically designed for MBA students and executive MBA students. It's a very decent book, and it doesn't get into too much calculus and calculation and graphs and stuff, but just enough that you would get the meaning and the concepts that is presented throughout the book. This is in third edition of Economics for Managers. Again, it should be a decent book because one way it has made it to a third edition in about 6 or 7 years. The assignment for this class, we're going to look at the list in just a moment. There will be four homework assignments. These assignments would come from the end of the chapter. You would do these assignments in Microsoft Word and put it in a Dropbox on D2L. By the way, the best way to get in touch with me is through the email, drjalavi@etsu.edu. The 50% of your grade would be these homework assignments, and another 50% would be exams. The exams would be all online, and you go to D2L under assessment. Exams would be up. You normally have about a couple of hours to complete the exams. The questions in the exams are all multiple choice, so it can be graded online automatically, and you would get an immediate feedback. I guess each exam would probably have somewhere between 30, 40 multiple choice questions, and I would put samples of questions you might expect in each exam about a week or so before the exam date. You will have a period of about 10 days, a week to 10 days to complete the exam, but once you open it, you will have a time limit to complete it. I would also put a sample of the homework assignment, so the solution to the homework assignment, so you would know what I'm expecting of you. The solution to any of the homework would be put on D2L after the due date. So again, you don't have to wait for me to grade the homework and send it to you. You can immediately figure out what you have done and what grade would be expected. On the third page, you have the grading scales. Again, this is normal grading scales for most classes here at ETSU. And from 92 to 100, for example, is A. 92 is A minus, and so on and so forth. A little bit about the grading policy, that it would help greatly if you read the chapter, read the case opening in each chapter before you listen to the lecture, before you come to class. That will help you understand things much easier. things would be familiar, the terminologies would be familiar to you, and it would go much easier. This is from past experience I've had with the people taking the class. Again, as you can see, number 3, you can contact me via email, and that is the best way to do it. When you send an email, in the subject you put the class and what your question is about, whether it is a homework question, homework 1, homework 2, or exam 1, exam 2, and I would normally check my email couple of times, 3-4 times, maybe sometimes a day, and I would get back to you as soon as I can. So here's the syllabus, and what the due date for each homework and each exam is. So in this column you would have the homework, and homework 1, for example, is due midnight of March 23rd. By the way, everything would have a midnight due date. The exam 1, which would basically be over the same material that you did the homework, would have from March 16, available on March 16, and it will go to March 30th. And anytime during this March 16 to March 30th, you can go on D2L and take the test. Again, once you open the test, you will have a time limit to complete it. So don't get up and walk around, eat dinner. Sit down when you know you have 2 hours free. Sit down and do the homework. As I said, do the exams. As I said, the exams are multiple choice, and they're randomly chosen from a test bank, and so each one of you would get a different questions. When you look at the homework 4 and exam 4, you would have a little tighter schedule because we are getting to the end of the term, so you would not have that much freedom of time to complete the homework and the exam number 4. So please be aware of that also. On the plus side, it's only 2 chapters 15 and 16. On the last page, you have the list of the homework assignments. Again, chapter 1, there is no assignment. I actually put the answers to all the questions in chapter 1 as a sample for you to browse and see what is expected when you do your homework. So we start from chapter 2. There is a section called technical questions. You would have problem number 3 and 7, and on the application questions you would have problem number 5, and so on and so forth. You would have several problems. Homework 2, the due date, and everything is on this last page. Again, if you have any questions about the syllabus, please send me an email, shoot me an email, and I will be more than happy to respond to you. And if there is any extra explanation you need. Let's start with chapter 1. And I'm going to use some PowerPoint presentation. Again, the PowerPoint presentations are on D2L, so you can make copies and follow along with the lectures as we go forward. Understanding of economics is important to the managers, so they would be able to analyze the internal issues to the company, the internal issues with regard to their customers, to the industry, and the impact it would have on their firm. Also, it is important to understand the bigger picture, what is happening at the national level and the international level. So what is happening to the economy as a whole? Are we in a recession? Are we in the period of prosperity? what is happening to the value of our currency, what is happening to the investment, what is happening in employment, inflation, and all those things. So you have two issues which a manager needs to understand clearly in their decision-making process. One would be microeconomics issue, the other one would be macroeconomics issues. On the micro level, what you are looking at is basically looking at consumer behavior. How is consumer behavior affecting your company? How is consumer behavior affecting your price setting? How is competition by others in the industry impacting the business? How is it impacting the price setting and how much you have to produce? So those are micro issues. How does the technology impact your cost, your individual firm cost? So those are microeconomic issues. On the macro level, you have the bigger picture, the economy as a whole. How is the employment, for example, impacting the business? How inflation is impacting the business? How is the foreign currency issues impacting your business? How is competition by direct investment from other countries here impacting your business? So those will be your macroeconomics issues. So it is important to understand all those issues that would impact decision-making process in your business. If you look at the opening case in this chapter, it is talking about the automobile industry. It is talking about the automobile industry in the U.S. So if you read it carefully, which, by the way, you need to read it carefully before you would be able to continue in this chapter. When you read the automobile industry carefully, you would see that there are several issues which are discussed in this case. Number one is talking about competition. So that is a microeconomic issue. Competition in the industry by other firms in the industry. What is, for example, what is happening to the taste of the consumers? What are they expecting? For example, do they want more airbags, more safety issue? So the taste and preference of the consumer is impacting your business. For example, on the macro issue, you look at the strength of Japanese yen is pushing the Japanese company to put more investment in their U.S. companies, in company Toyotas, Hondas, and Mazda, and all those companies. So that way they would bypass this fluctuation in the exchange rate, and also they can bypass the tariff issue and the quota issue on the U.S. So directly they would get the product produced in the U.S. and give it to the consumer. Doing that also, it is improving the employment in the U.S. So that is also a macro issue, macroeconomic issue. So employment in the U.S. is better, prosperity would be better, therefore consumers would have more disposable income to spend on stuff, including on automobile. So they would be able to do all those issues that they can look at it clearly. Whether it is automobile industry or any other industry, you're looking at a spectrum of the market structures. And you look at your business, you look at the different business you're studying, and see what kind of market structures are they operating under. The two extremes of the market structures are one side, perfect competition. So you have a perfectly competitive market for your product. This is when you have numerous firms producing standard product. So the products are exactly the same thing. So you really do not have that much control over the price setting issue. The market would dictate you how much you can charge, and you have to charge that. The only thing that would improve your profit margin would be on the cost issue. So if you're able to provide the same product as your competitors at the lower cost, that means you would be making more profit than others. On the internet, you have so many companies doing business, and so as consumer, when we go on the internet looking for a product, we have so many companies offering the same thing, so we can compare prices and compare services, and based on that, we would make a decision where to buy and how much to buy, and that would of course impact the business, the profitability, and so on and so forth. On the other extreme of the market structure, you have monopoly. Monopoly is when you have a single firm producing a unique product which doesn't have any competitors for it. So there would be some challenges in the monopoly also. We're going to discuss that. And again, most people think that because you have a monopoly in the market and you're the only firm producing this single product, you would definitely be making profit all the time. But that is not always true. Or you can be a monopolist and lose money. So we would discuss all this market. In between the two extremes, the monopoly and perfect competition, between the two extremes, you have monopolistic competition and you have oligopoly. Again, monopolistic competition is closer in character to perfect competition. In that, there are many companies producing a product which are similar to each other. They are not exactly the same, but they are similar. In that, for example, in restaurant business, you go buy a hamburger. So whether the hamburger is provided by a local store or a hamburger is provided by big chain like McDonald's or Burger King, they basically are the same food. And it has a piece of meat, it has some lettuce, it has tomato, and it has a hamburger bun. So basically the same food. Now the difference would be in presenting that same kind of food. The difference might be a little bit price difference between the two. The difference might be through commercial, through advertising, persuading you that one is better than the other. So in a monopolistic competition, now you have advertising. That is very important. Advertising is trying to persuade you to come to my company instead of my competitors. For maybe some minor differences, some differences which might just be a perception that I'm providing a better service or a better quality. So that would be monopolistic competition. On the oligopoly, which is closer to monopoly, oligopoly is when you have a handful of firms, 2, 3, 4, 5 different firms controlling most of the market. As for example, look at the market for soft drink. The soft drink industry is controlled basically by the two major companies, Coca-Cola and Pepsi-Cola. They control most of the market. So they have they have control over the price. Some control they can dictate over the price. So that would be a special character. Even when you look at the automobile industry, that can be oligopoly form. There is still competition, mind you. There is still competition amongst the firm. The competition would not disappear because they are trying to get market share from each other. So, but nonetheless, you have a handful of firms which are controlling 80%, 90% of the market. Look at the beer industry, look at the wine industry, so on and so forth. A lot of industries, you look at the fast food industry, you look at a lot of industries around you, and a lot of them would fit under oligopoly situation. We will discuss in detail these companies later. Again, in the next few slides, you would see the definition of what a perfect competition is, and you can read that monopolistic competition. What is the characteristic of monopolistic competition, oligopoly, and also monopoly. In the monopoly, you would see it a lot in the pharmaceutical market, in particular in high technology market. When somebody has a patent or a license for something, for a way of doing business or for a particular product, that would give them the monopoly power in that market. So in a sense, government would allow them to, through patent and license issuance, would allow them to be a monopolist in the market. Now, the microeconomic issue has to do with consumer behavior. We talked about this a little bit, and you look at how to produce the product, how much technology you use, how much labor you use, how much capital to use. So those are the decisions you have to make to produce a product at the lowest possible cost, so you would be competitive in the market. Again, with the macroeconomics issues, you're looking at issues such as inflation, such as interest rate, exchange rate, the state of technology available to you, and the global market. Whether you have recession in Europe or in the Far East, or you have a big market in the Middle East, and so on and so forth. So those would be all macroeconomic issue for the manager to consider. To explain macroeconomic influence on business, here, let's bring this up. We can show that through what is called the circular flow of economic activity. The circular flow of economic activity. So we look at the markets and the players in the market. Okay? We look at the markets and the players in the market and see what influence they would have. So let's actually let me make this larger, and this is I made a little bit of change in the slide to understand this a little bit better. What we have here is two players in the market, which is the household sector, that is you and I, who provide the labor, provide the capital, and the firm sectors. These are the businesses who produces stuff, whether it is a service or it is a product that they produce, and they present it in the market for goods and services. So here is a market for goods and services. And also at the bottom, you would see resource markets, right? So in the resource market, households, you and I, are providing the resource market with the labor we have, providing the resource market with the capital we have. And for that, we would get an income from them. We would get income, wages, rent, interest, and profit would come to us from the resource market. Now, in turn, let's go this way. In terms, the firms would be able to combine these resources, the labor and the capital that was provided by the household, to make a product. The product they make, they're going to sell it in the market for goods and services. So here you have the market in goods and services. Who is going to buy this stuff? Again, we are looking at the closed market with the absence of government. This is a very simple market with the absence of government, no foreign companies. So the only one who would buy this stuff from you are these households. So you and I, we go to the market and we buy this stuff that was produced by us, right? In economics, there's an expression that says supply creates its own demand. Supply creates its own demand. What does that mean? It means you and I are going to produce a product in a firm, in a company, and then they would give us the income. And once we have the income, we go to the market and buy basically the same thing we produced. Okay? So the more we supply as a country, the more we supply as a country, the more income, the more wages we would have. And the more wages and income we have, the more we would be able to spend in the market. And what we spend in the market, by the way, is called consumption, shown with C here, right? This is consumption by household from domestic markets. Also, buying from domestic markets, the businesses need to buy stuff too. They need to buy cars, they need to buy office building, they need to buy the same stuff we buy, basically technology. So for them, what they buy from the market is called investment. So that's I. So at this point, let me see if I can write this. What we have here, we say that income that is produced in the whole country equals consumption plus investment. Let's call this production. Equals consumption plus investment. So whatever is being produced in the country is equal to what is being consumed by household plus what is being consumed by businesses, which we call investment. If we call this production, which we do, we call it gross domestic product. Gross domestic product. So at this level, in the absence of government and foreign sectors, gross domestic product, which is whatever is produced domestically, would be purchased by either households, which we call it consumption, or by businesses, which we call it investment, so C plus I. So GDP is equal to C plus I. Okay? So that is in a simple closed economy with the absence of government, with the absence of foreign sector. Okay, let's go back and add a little bit more to this circular flow and see how that will go. Okay, again, this is a closed economy. Consumption plus investment is taking care of everything in the market. Everything in the market which is being produced is bought by consumers and or businesses. So let's add a government sector here. So here in the middle, we have a government sector. What does government do? Two things. Number one, the government is taxing businesses and taxing the household. That would be their income. So here, personal taxes, TP, is coming from the household in the government, and business taxes from businesses, business taxes, is going to the government. That's the main source of revenue for the government. Personal taxes plus business taxes, right? With that income they have, they are going to spend the money buying goods and services, the same as the household do, the same as the businesses do. Okay, so now we have a new player in the market who is demanding the same stuff that is being purchased by households, that is being purchased by businesses. Okay, so here is a government sector. If we want to go back, let me do that and bring this up. Now you can say that the GDP of the country, what is being produced in the country, is now equal to consumption plus investment plus government expenditure, G. So these are household spending, this is business spending, this is government spending. The total of this spending would be equal to what is being produced domestically in the country. Again, there is no foreign sector so far. Okay? Now, let's go back. And government sector is added there, right? Let's add something else. Let's add another market to make things come a little bit closer to reality. This new market is financial market. These are banks, right? Primarily the banks. What is the role of the banks? The role of the banks as depository agent. You know, when we have money, we put it in the bank with our saving. So this is household saving, goes into the bank. And the bank use this saving by household. And there might, by the way, be some saving by the businesses, right? And of course, no saving by the government. So this saving by the household and the saving by businesses goes into the financial market. And what do? They use this money to lend out. To whom? To the household sector and also to businesses. Businesses borrow from the bank, household sector borrow from the bank. Why do they borrow? Because for household sectors, their income, their wages, rent, interest rate may not be enough to buy what they want for their consumption, so they borrow more money. And business sector, why do they borrow money? Because they don't have enough money to get the resource market, to get the resources they need, and or to buy the product they need. So we are at the level where we have three markets. One is domestic markets, one is resource market, the other one is the financial market. And still three players: the firm sectors, the government sectors, and the household sectors. Right? You have these three players in three markets. Right? Now, to complete this circular flow of economic activity, we add the foreign sector. You add the foreign sector, right? These are other countries. Other countries buy stuff from us and sell stuff to us. So here for the foreign sector, you would see the domestic market. We import from them, that's M, at the same time from this export market, we sell something to them. We sell something, that is our export. So we buy from them, that is called our import. We sell to them, that is called our export. So now let's recap this. So you have a domestic market which is producing stuff, goods and services. Okay? So what is produced in a country over a period of a year is called the gross domestic product. Gross domestic product. Okay, so the GDP of the US is $15 trillion, for example. $15 trillion. Right? Now, who is buying this stuff that is being produced in the country? Who is buying the stuff that is being produced in the country? Well, the majority of it is bought by us, by households, by you and I. That is our consumption, about 70% of it. So part of the GDP would go to consumers, to households. Part of the GDP would go to businesses in the form of investment. So they buy stuff to office building, automobiles, papers, whatever you think. They buy it from the market. So part of the gross domestic product is being purchased by businesses. Part of the gross domestic product is being purchased by the government through G. Right? And part of the gross domestic product is bought by foreigners. That is called export, X. Right? And since we are calculating GDP, you can see part of this consumption in the market, part of this government expenditure in the market, part of this investment in the market, we may not buy only domestic product. We might buy some foreign product. That is part of the M. So part of the M is going to the consumers, to households. Part of M, part of import is going to government. Part of import is going to businesses. Therefore, since we are trying to calculate gross domestic product, we have to subtract this import. Because this import is not our gross domestic product. We did not produce that. But we purchase it through consumption, through government expenditure, and through investment. Therefore, to get the gross domestic product, we would subtract M. Therefore, we go, let me see where it was, right here. We go right here, one more level with the gross domestic product, with the gross domestic product. Now it would be consumption plus investment plus government expenditure plus export minus import. Okay? This last part, C plus I plus government expenditure. This last part, get rid of this. This last part is called net export. Net export. For most of the years, 30, 40 years, 50 years, past 50 years, net export of the country has been negative. What it means is we are importing more than we are exporting. Okay? So we have to subtract that to get our GDP. We have to subtract a certain amount to get or GDP. You can get this information, by the way, on consumption, investment, government expenditure, export, import, all of this stuff from U.S. Statistical Abstract. Just go online, type United States Statistical Abstract, and it would be for free. It would pop up, and it would be for free. You can get the information on past data for gross domestic product and consumption and investment and so on and so forth. This last slide, we already talked about that. Macroeconomics, factors like the inflation, exchange rate, interest rate, and economic growth. Knowledge of these factors and how they affect your business is a key factor in developing a competitive advantage over your competitors. Again, if any question comes up with these, you can email me, and I would be more than happy to answer you. That's the end of chapter 1. As I said, there is no homework from chapter 1. I put the solution to the problems at the end of this chapter on D2L. So that would be a guide for chapter 2 homework you're going to do and turn in soon.